here. I was thinking the opposite. When nobody was waiting, when I turned this thing on, I thought, man, what happened? Everybody stay up too late trading and slept in and don't want to go to the morning briefing. What a move, huh? Europe just came out with some employment data and said the underlying employment data is weak, and they did not cut. And Powell kept talking about unemployment or employment yesterday, and we've got employment data this morning. So front and center, all eyes on that. Good morning, everybody. We got the 10-year today too, my baby. I haven't got into the why on why they didn't cut. I think because they had already projected that they wouldn't. They're more sensitive. That's a good word. They're more sensitive to the language that they'd already put out. And so if they had already laid out a case for not cutting, then they weren't going to cut, even if they're starting to get worse data. It would have been a shock and awe to have projected no cut and then got that negative employment data that they got and then follow that up with a cut. It would have sent their markets into a tailspin. The quote that I saw that really got my attention is BOE, the staff model, suggests underlying unemployment has increased steadily over the past quarters in contrast to the official data. Boom. All right. Good morning, everybody. So we made it through FOMC, but the fun isn't over yet. We've still got triple witching at the end of the week. We've got job numbers coming in and jobs data coming in. Powell touched on this over and over again. It was a fundamental part of Jackson Hole and everything that he talked about there. And it was a really big part of what was going on yesterday. It caused that massive August drop that we all saw with a 65 VIX and everything getting shook loose. It's all about employment at this point. They're past the point of looking at inflation as their greatest risk. And now it's let's not crash everything and burn it to the ground. So anything jobs related is going to be a really big deal going forward, as it has been for the last 6 weeks. It's just, we're just taking it up another notch. We're going to get some of that jobs data today. And this isn't the non-farm payrolls data, but still it's a part of that data package. So as you can see, green on the screen around the world, we lit it up and it continued to flow overnight with more data coming in from around the world that just supported this push. Everything looks really good with small caps up 3%. Wow, right? Just wow. Even Hong Kong, which is beaten down, forgotten, nothing, is up 0.5% this morning. Cutting when we're at all-time highs has its own history. The previous iterations of this led to like another week of bullish activity beyond the cut before everything began to unravel. If you think about that in a timeline with economic data, in the past, say we got a cut at all-time highs, the market rallied up even higher, and then jobs data came out or some other outside data came in, and that was the switch that got flipped and sent us into a tailspin. I believe the last move was 7% higher before the data sent us like 14% to the downside. It was pretty violent. Initial jobless claims and some, the home sales isn't anything to ignore either. We've had one sector that's just been doing really good. And if we're going to get a rotation out of that, it would very likely start with some bad data. So one thing that got my attention when I was looking at these numbers is the forecast and the previous. They're expecting a lower jobless claim number. So we don't want to see that come in hot. Now, this is one that we see manipulated all the time where we'll get a big headline number and then behind the scenes when nobody's looking, they'll put out a revision. It's just the way it is, right? It's just the way it goes. And it always shows auctions as a light impact. And I can't stress enough that sure, if it's the 4-week or the 52-week, something like that, maybe you could kind of ignore it. Maybe I wouldn't, but you could probably let those ride. But if it's the 10, the 20, the 50, keep your eye on those. Or the 30, I mean, the 30, the 10, 20, 30. Those are the ones pay particular attention to. And today we've got the 10-year. So it's kind of a big deal. Keep your eye on it. Underlying unemployment has increased steadily over the past quarters in contrast to official data. That about sums it up. Call wall at 58.11. I just adjusted that a little bit, but 58.11 is the cog line. It's close enough. 5,800 round number. 57.92, which is another options level. It shows it at 89, but 89.92, close enough. We are already above the second ADR level. Current ADR is 76 points. Generally, the market over the last 21 days has made an average daily move from its highest to its lowest point, about 76 points. That's the average move over the last month. Well, we've made all 76 of those points in a single direction, and we did it with half a trading day. Generally, if we've made it this far, the expectation would be that we're going to turn around and either stall here, stay here for the rest of the day, or turn around and go back the other way. But there is a third option. This comes in when we get an overnight gap that's so big that it doesn't get closed. There's some statistics on this sort of gap. I'm going to try to pull that up here in a moment. They're from Edgeful. I know what the lower gap side is without even looking. If we were gapped down this much, we would have zero chance of closing that gap today. But we're not gapped down, we're gapped up. So we're looking at the E-mini. I should have checked to make sure I was logged in, but yeah, I guess I am logged in. So we've got the E-mini. We're looking at gap fill. Gap by size. If it's an upside move and we're gapped up, the likelihood of it getting filled is here. So we are up 1.5%. Closer to 1.75. This is how many times we've filled a gap when we've been gapped up this much. 100% of the time, we don't fill the gap when we're gapped up this much. That's a statistic for you. Now, granted, I'm only using, a small amount of data, so I can increase that, say, 5 years. Well, we'll let it think about it since I just asked it to do a big job, and we'll do something else while we wait. Either way, there is a thing called a gap and go, right? There's different kinds of gaps. You got exhaustion gaps, breakaway gaps, earnings gaps, event gaps, gap and goes. There's all kinds of gaps. Generally don't want a gap and go from the highs. That's not generally what you want, but we do get them on the ES. There is a precedent for that. So it's worth being mindful of it. People who've went through my coaching knows that we talk about these kind of special days. There's 4 different kinds of trend days that are unique. It's not just the idea that we have trend, because we can find trend anywhere. It's the idea that there is a very unique kind of trend day. And some of the qualifications for that trend day is that we have to be outside of the previous day's range. Because if today's price is in the same range as yesterday's price, then we don't have a trend, right? You're not trending if you're still where you were yesterday. Over the last 5 years, if we've been gapped this much, we've filled 12 times. So there's your stat on that. 12 times in 5 years. Out of 24. I guess that's about half. It's not, that doesn't sound so great at that point, huh? So these unique kind of trend days start with a checklist. Are we outside of the previous day's range? Yes, check. Did we have some outside extraneous event that caused us to make this move? FOMC, check. Europe rate decision and unemployment, check. Are we going to close the gap? It would start with these ADR lines since we're already above them. If we drop back below the yellow line here, then we would focus on getting back inside of yesterday's range. If we get inside of yesterday's range, then we focus on getting through the red ADR line here. If we can get through that, then we'll focus on 50% of yesterday's range, then yesterday's open from the RTH, then yesterday's low, the 10-day moving average, and it's just level by level on down. But what's the other side of that is, what if today's going to be a trend day that we've already gapped up, we've already run, you're going to have people trying to short it. And if those shorts get ran over, they have to buy to close. That adds to the buying, it adds to the fuel, and it just keeps going. We're also still in negative gamma on the SPX, right? I was looking at that. The SPX gamma flip point is the 32 cog line, and we closed at like 18 something. So if we're still in negative gamma, and the gamma got moved in the overnight, I'm still waiting on the AM edition, then we could see selling into selling and buying into buying. Well, the buying into buying part is what's going to be important, because if we're ripping and the market makers are hedging their gamma and they buy as we rip, their buying is going to make us rip more, then they're going to need to buy more. It's going to make us move more. It's a feedback loop. It's just going to push us higher and higher and higher. So sure, we're up 1.7%, but that's nothing. I've seen the ES make 5% moves on the day. I've seen it trigger lock limits at over 7% and freeze into place before opening back up and moving another 3%. 1.7 is not an overly large move yet. So while our base case argument is we'll hold the line here and we will base or fade, be prepared for a continuation. I think that call wall up at 58.11 is in play at this point. We've certainly got the volume for it. The overnight volume reached 116. That's not, you know, the highest volume we've ever seen. And there is the triple witching that has to come into some of that, you know, a consideration that maybe a lot of this volume is just rolling. It's the worst time in the world to have, you know, this FOMC event and all of this extraneous data coming in to also no longer have the ability to see hedging the way that we normally would. But it's just the way it all shook out. Volatility trigger 0 gamma, long ways off at this point. And the put wall, 57.72. So level by level, as long as we continue to make highs, don't try calling the top here, because this thing can just keep going and going and going. And the more people try to short it, the more they're just adding to the fire, right? So far, it's doing exactly what we would expect a market to do. It ran right up to the 1,236 and paused there the way it's supposed to. Got a gentle pullback, and now it's trying to continue. Got a couple of different ways that we can run this model. The simplest one would be to just add 1.5. So we've measured all of yesterday. That's what we have measured here. And we project that 50% higher, and we get 57.96. Well, that's close enough to 58, right? So 57.92, and then 5,800 round number, and then 58.11. That would be the call wall, and it'd be where I would expect things to slow down. Also, keep in mind the SPX will get these levels, the ADR red and yellow. It'll get it when it opens at 9:30. The ES is already at these levels. The SPX will not be at its levels. And there's times where the ES is already here and we break above it and we continue to go higher, and people start asking, how far are we going to go? We've already made the ADR, but the SPX hasn't. So we keep going higher until the SPX finally does hit its ADR, and then everything stops. So something to think about as well. Another reason to believe that this could just continue to go higher and higher and higher from here. That's not the base case argument. I'm just laying out a case for that argument. Also, we're not overly extremely distant from VWAP. Sure, we're a little elevated from VWAP at this point, but we haven't outrun it radically and drastically at this point. Central pivot range. Today's range is nearly the same as yesterday's range at its location, but the width of the channel today is much bigger than yesterday's. So overlapping channel like this is more of a neutral bearish basis, and price opened underneath it, which is also considered bearish. A wide channel implies we won't break out and run. I think you got that one wrong. And so two bearish sentiment signals are obviously discounted. And the metric that says breakouts will likely fail today is also obviously discounted. So way down here is the weekly pivot. And we do have to be mindful about how far away from the weekly pivot are we. In August, we've seen a 6.5% run to the downside away from this pivot. Right now, we're getting close to 4%. I didn't tag that right at the top, but close enough. We're pretty close to 4% on the distance from the weekly pivot. I don't have a good metric on how far is too far. I've tried to build an indicator that would quantify that, and I didn't get as good of results as I would like. Mainly because unlike a moving average that stays consistent, this floor pivot is recalculated every week, and so it tends to throw everything off. Having said that, be mindful of how far away from that pivot we are. If this isn't the extreme yet, then I'd say we're getting close. It was 6.5 to the downside. So 4 to 4.5 on the upside would seem to be a number of concern. And these SNR levels, like I mentioned yesterday, or maybe it was back here, Tuesday, if we get above this R2, the chances that we go back down today are very slim. Now we've got data coming in at 8:30, and that can get us through there on a like a big wick bar. That's not what I'm talking about, right? Just because price flips into that area, that isn't good enough. If we continue this grinding move and we get above there, the chances that we come back down below it after the open is a lot lower. So we want to see where we open at 9:30, if we open above that R2 level or not. That feeds into a gap and go. Even though I don't like gap and goes from the highs like we have here, it fits, right? If all the pieces are there and it looks like a duck and it quacks like a duck, then it's probably a cat, right? So whether I like it or not, if we get up there, then it's very likely going to be a gap and go. Because of the auction at 1 o'clock, even if we do remain bullish through the morning, you still need to be very mindful when we get into the 1 o'clock time frame that we can get a rounded reversal day. That is another one of my 4 trend days, and it fits this scenario. We've got examples after examples after examples of this same setup. 10-day, 30-minute volume profile. It's basically on the cog line, 56.92. Unless we get some kind of shock and awe, I don't see that that's going to move again anytime soon. Notice that we have TPO as well now lined up with us. We had talked about losing more of this volume along the low and losing that point of control from down here and seeing it shift up. We got it. So now we need to keep it. If we continue this grind to the upside, it will exceed our expectations on how far price needs to get away from the pivot before the pivot can start acting as support. If we're just hovering in that zone, then it's just supportive, or it's just like a magnet. We can crisscross through it on either side. But now that we've left the range, especially if we continue to go a little farther from the zone, if we come back to it at that point, we would expect to see it respond to price, to see supportive behavior there. At the very least, one thing that we can state for a fact, which is never in question, that's where the greatest amount of trading took place. That's not my opinion, right? Whether I think it may or may not be supportive, yeah, that's my opinion. But that is where the greatest amount of trading took place. Trader's remorse. If you got in there and a week and a half later, you find price right back where you got in, what are you going to do about it? You're probably going to adjust your trade. You and everybody else that got in right there. So whether or not it'll be supportive, it's very likely going to be a key level. 5-day, 5-minute chart, we wiped out that VPOC level yesterday. So that's gone, no use to us. We don't have a new one from yesterday because we've already crossed through that level multiple times. But we do have some issue this morning. I'm just going to open the sidebar so that things will kind of squish up a little bit. Makes it easier to see this chart that we're focused on. We don't want it too spread out at this point. So we got some issues here. Point of control is up at the highs. We ran up, stopped, got some volume, tried another breakout, got some more volume, another breakout, we got some more volume, another pause, more volume, and now we've got this structure up here, and it's the greatest amount of volume from the entire run. Greater than where we stayed digesting for 2.5 hours, greater than this peak, which didn't really have any volume to it at all. Got all this volume. It's where the greatest amount of trading took place right here. We see it with the point of control. Kind of looks like we just ran right up into a ceiling. Now, we've seen profiles like this where we run up into a big ceiling and we digest through all of this and we keep going on the other side. So it does not have to be the end of the run, but it very likely could be. This is a big deal to have all of that volume there. On the dome, you're going to want to look at levels above it and see if they're replacing and stacking at this point. So what you'd be looking for is how the orders are coming off of the dome and how many trades are coming in. Well, we can see that the trades aren't there. That's what this blue one is over here. Trading that's taking place versus the volume that we're getting. So this wasn't because of a lot of trades. This was a few trades with a lot of volume. We can see that there has been some trading activity, just nothing close to what we were getting when we were down here. So it just like we always talk about at a pivot point, as long as we stay here, we can just chop here and we can just hang out all day. But if we leave this range and we come back to it, we'll expect it to be supportive. Or if we leave this range and we come back to it from the other direction, we'll expect that to be a resistance, right? But until we leave, it's just going to be our magnet. All right, it's the question that I'm sure a lot of us are trying to figure out today. Did that move yesterday move us too far, too fast? Or what about the overnight run? Too much? Too fast? Does it owe us a pullback? Looking at the weekly, no. We're getting back into our healthy spot. We want to see this above 2, and we're not there yet. So we could run some more to the upside, and we still wouldn't be overbought, but we would be getting into our sweet spot on the distance from the 10-week moving average. Flip this indicator over to the daily, and we can see that we're above the 10-day, no surprise, but only a little bit more than 0.5%. 1.5 is kind of where our sweet spot is. And when we get farther than 1.5% from the 10-day moving average, we start to consider overbought scenarios. We're nowhere close to that. So as much as that move in the overnight looked and may feel like we've run a long way and we're due for some kind of pullback, nope, we're not overbought. We're not overextended. It doesn't owe us a pullback or any sort of mean reverting dot plot statistic least squared method reaction function at this point. Now, things can get different really fast, right? So be mindful of that. When the data comes in today on the job numbers, it's not going to care about pivot points. It's not going to care about, volume profiles and points of control. It's just going to look at what Powell said about employment and what the employment numbers are signaling, and it's going to respond to that. We're getting closer to QRA also. It's not front and center yet, but it's coming, right? We got the elections still. We've got QRA and 2 more FOMC meetings on the year. And the projections that I heard this morning were a combined 50-point reduction between now and the end of the year, whether it's 25 twice or they skip one and then hit with 50, who knows, right? But there's still room for shenanigans. And so we'll have to see how that plays out. But to me, the next biggest threat is QRA. I was beginning to think yesterday that maybe the short in gold was the wrong way to go, because it just kept going and going. I'm like, oh man, I'm going to get murdered. But it did finally flip. So, if you got out of that thing, good, because it's back again. Looking at the VIX structure, we're still in elevated VIX territory. We need to get this nice and easy back down below 15. Getting through OPEX this week is going to help. We still don't have the AM founders note yet, but I'm sure they're going to have something to say about the volatility. One step at a time, get this back below 15. And I don't think we're going to get it anytime soon. We've been holding this structure here around that 15 level, between 15 and 20, with little spikes above and below. That dollar resurgence was the smackdown on gold that we saw. And then the dollar getting flipped and falling right back down was the gold also flipping and running right back up again. So if you are playing in that gold complex, Keep your eye on the dollar right now. It's a useful tool. It won't always be, right? But use it while it works. And while this move in the S&P is awesome, we're not really seeing that sort of risk-taking behavior in the carry trade. It's very muted, and it did not participate in this risk environment. 2-year also with the dollar made that flip move, and then it's right back down again. It's worse off than the dollar is at this point, but certainly one to keep your eye on, especially since with these flips, we didn't see that sort of behavior in the ES, right? If you look at this move, that's where the dollar started to run. And we had the ES moving up with it. And then the dollar moved and started going in the other direction, down, and the ES continued to go up. 2-year, same thing. So proceed with caution, I guess, is really what you want to focus on. Because we had the ES moving up with the dollar moving up. And now we have the ES going up with the dollar going down. It's not going to be really helpful on you on that. But gold, it'll still help you with gold right now. Take what we can get. My icons look different this morning. Speaking of icons looking different, the Apple iPhone 18 update is pretty cool. All right, things that are down, nat gas. Surprise, that thing's a turd anyways. Don't trade this. If you want to play in nat gas, you know, better off playing it in a proxy rather than something like UNG. Things that are up, Bitcoin really taking on some risk, 5.25. Silver playing catch up. Big gap up way up here. Although we just got some dark pool. China ADRs, also a large gap up right into the anchor to VWAP. That puts us above the 50. And we've got examples of this since we've been kind of working on this downward move where we've got above the 50 and then dumped back down. Now it's starting to flatten out a little bit. This 50 is, but we've seen examples of that too. So it's got to get through this complex up here before we really want to try taking China long. It's just not ready yet. LRE is one thing, low risk entries. If you could have got in down here, even though we didn't have any really good long signals, that would have been your lowest risk area, LRE. Now that we're not near those lows and we're this close to a significant resistance zone, let's get through that before we start looking at those China ADRs. Baba, Baidu, JD, PDD, XPEV, NEO, all of those, right? We really don't want to mess around in that space unless any of those have an LRE, because this has to get through this structure first. Solar's up this morning. kind of expected to see yields looking a little different. Semiconductors, another one that really big gap up. We are inside day breakout at this point. So we've left yesterday's range. I think we're going to find this on a lot of products. You know, after we have a really big day and then we're stuck inside of it for like 3 days in 85% of the market, nothing can get out of that range and it's just fighting it. Well, that's not this. Now we're going to have 80% of the market with that gap outside of yesterday's range already through resistance and ready to go. Now, on one hand, it kind of sucks, right? We see a lot of these things that we would want to trade that's already made really big moves and feel like it left us behind. But on the other hand, it gives us a lot of structure to play against. So take SMH just to use for our example. Now that we've got an inside day breakout this morning, yesterday's highest point can be our support level to focus on, that we were looking for maybe something like a Busby. Price breaks out, comes down and tests the old resistance as new support, uses it for a springboard to continue to the upside. It's one way to go. If that level fails, you do have one more because we were sideways for a couple days in SMH. So you got another level lower and around number 2 at 237. But we really wouldn't want to see it go any lower than that, right? That's about as much as we want to give it. For a more qualitative number, you got your 786. It needs to hold above that. So if we do get back inside yesterday's range and we look for a springboard, it has to be at or around that 786. If we drop through that, it's game over. We'll run it to its lower levels. I think a lot of things that on the equity side are going to have this set up. We can see Apple back up in this zone. That has been a consistent sell zone since 9.5, and really we can back that up into this 9.3. Every time we've gotten into this area since then, we've sold out. Now, on the one side, every time we get into this area, we're absorbing more and more of that liquidity. How many more sellers are there? Once we wipe all those sellers out, there isn't anybody left to sell there, and we're going to go higher. But if the market continues to test this level and there's just so many sellers that we can't make it through, the market's going to give up on that level and it's going to go back the other direction. Well, we don't know yet if it's going to prove to be that or not. This is today's trading. I know it might look like a daily chart, but I'm on a 24-hour chart. So we've left a gap behind. We're inside day breakout. We're making a run to get through the top of this liquidity, call it 226. If we can get through that 226, then we've got a chance of getting into 230 and then getting into this zone up here, which also has history of selling, and we don't know if we're done yet. I would say very likely that we're not. Looking at the candle that's in control, which would be this big red bar back here, we can see the half back, 225, nice round number. That gives us a very clean little zone here. 50 cents wide. Get through that, and we can make a run up to 230. Now that Apple's up this much, if it fades, it has to bounce at yesterday's high or yesterday's close. Anything lower than that, and we will revisit some lower levels. We don't even want it to do that, right? That we don't even want the gap close today. We just want it to run. All right, Microsoft's already had a really good run. Now we've got this indecision candle, and we're still inside it. So we're IX10 at this point. Got to get out of the box. We're through the halfway point, so that's a good start, but we have to keep it. So stay outside of yesterday's range. Step one. Break this IX10 range, step two. Then we can continue the move. Call it 146.5. That's not bad from 438. Amazon's already got the breakout. It's already outside of yesterday's range. It needs to keep that. It can fade back inside this 917 bar, but at this point, since it's expanded so far, we don't want to see it fade back inside of yesterday's bar. $192 on Amazon if it continues this upside move. There's your sell zone on Google. Previous selling took place at this level. We don't know if they're done yet. Very likely they're not. It's already had a long run. You know, how many days in a row can it run green before it gets a red day? We also have this really big gap up. So at this point, we have a cup. We don't know if this is going to be a double top bull trap or if this is going to be a cup and a handle. We won't know until we overshoot and get rejected, or we don't overshoot. We get right to the level and we pull back and we get that handle. $237.5 and then $240.5 for Tesla. It hasn't even made its inside day breakout yet. So it needs to get outside of the range first. And the fact that it hasn't even been able to get out there yet, it's a little bit of a concern. Everything else is bullish. Where's Tesla's enthusiasm? So maybe it's a late bloomer. On the other side of that, maybe it's a bellwether. Canary in the coal mine. Financials, jets, biotechnology, cloud computing, expanded tech, communications. I mean, everything is up this morning, everything. And I can't stress enough, just because it's up across the board this much, don't immediately try to short it just because you feel that we've gone too far. Because I'm going to argue that we have not gone too far, and that with this global enthusiasm on this push, you would be fighting against the entire market dynamic, which all of that can change as soon as we get some employment numbers, right? So if the sentiment changes, great. There's this odd thing about options and how much options can affect things. Gamma levels, market makers, and their dealer gamma positioning. But there's times where the market just throws all that out. Sometimes it focuses really hard on treasuries or commodities or some sort of news. Right now, it's going to be unemployment, and it will override everything else. Yeah. So watch the news. You got your levels. Try to contain your bias on this radical assumption that we're due some sort of move in the other direction because you think it owes us some mean reverting flip back the other direction. Because at this point, it does not owe us anything. Be careful, be safe, guys. I'll see y'all tomorrow. Watch the clock.